Welcome! Today, we're going to pull back the curtain on something that affects almost all of us, insurance. And we'll be doing it using the fantastic insights from Dr. Sudhindra S.G.'s work to really understand how this whole industry actually functions.
The entire idea of insurance really boils down to one simple but pretty powerful question. How is it that paying a small, predictable amount of money can protect you from losing a huge, unpredictable amount? That's the puzzle we're going to solve together today. All right, so here's our game plan. We're going to start with the stuff we care about, our assets. Then, we'll look at the dangers they face, these things called risk and peril. After that, we'll check out the amplifiers that make things worse before getting to the brilliant solution, the power of pooling. And finally, we'll cover the all-important rules of the game. Okay, first things first, before you can even think about insuring something, there has to be something of value to protect in the first place. And in the world of insurance, that something is called an asset. So what exactly is an asset? Well, it's pretty much any resource you own that has some kind of economic value. It could be something that makes you money, like a piece of factory equipment, or it could be something that just serves a really important need, like the refrigerator in your kitchen. Both are valuable, both are assets. And this is a really great way to think about it. Your car? Absolutely an asset. You own it, there's a limited supply of them, and it gets you from A to B. But what about sunlight? I mean, it's essential for life, right? But you can't own it, and thankfully it's everywhere. So in financial terms, it's not an asset you can insure. It really comes down to two key ideas: ownership and scarcity. Okay, so we've got our assets, the things we value. The big problem, of course, is that life is full of things that can damage or even destroy them. So let's get specific and break down what these dangers actually are. First up, we have risk. And risk is just the chance of a loss. It's the uncertainty, the what if. There's a risk your car could be in an accident. There's a risk your house could catch on fire. It's just the possibility that something bad might happen. Now, if risk is the what if, then peril is the what. It's the actual thing that causes the loss. So the risk is that your house might get damaged. The peril is the actual fire or the earthquake or the flood that does the damaging. Peril is the cause. The loss is the effect. Simple as that. But here's a super important point. A peril happening somewhere else doesn't matter. You have to be exposed to it. I mean, a flood in another state is a terrible peril, but if your house is hundreds of miles away, you're not exposed. For a loss to actually happen, your asset has to be in the path of that danger. So not all situations are created equal. Some conditions out there can take a bad situation and make it a whole lot worse. These are the amplifiers, or what people in the insurance world call hazards. A hazard is basically any condition that cranks up the dial on a risk. It either makes a loss more likely to happen, or it makes the loss way more severe if it does happen. Think about it. A fire is a peril. But a fire in a building with old, faulty wiring and no smoke detectors, that faulty wiring is a huge hazard that makes a catastrophe much more likely. And this table just lays it out perfectly. Look at this. For the asset of a person's life, a peril could be cancer, and a hazard that amplifies that risk is excessive smoking. For a factory, the peril is fire, but the hazard is leaving explosives just lying around. And for a car, the peril is an accident, which is amplified by the hazard of careless driving. You see how they all link together? Insurers usually think about these hazards in three main buckets. You've got physical hazards, that's the faulty wiring, an icy road, stuff like that. Then there's moral hazard, which is about dishonesty, somebody intentionally causing a fire to get the insurance money. And finally, there are legal hazards, which come from the legal system itself, like a new law that makes lawsuit payouts much bigger than they used to be. Okay, so we've got our valuable assets, and they're facing all these risks, perils, and hazards. It sounds a little scary, honestly. But this is where the absolute genius of insurance comes into play, with a really elegant solution: the power of pooling. So let's use a great example from Dr. Sudhindra's work. Imagine a town with 100,000 houses. Every single one of them faces the risk of a fire. Now, if your house burns down, that's a financial catastrophe for your family. So what do? Well, this is how pooling works. It's incredibly clever. Step 1. Everyone contributes a small, affordable amount, the premium, into one giant shared pot. With 100,000 homeowners, even a small contribution creates a massive fund. Then, when the inevitable happens and a few unlucky people lose their homes to a fire, that giant fund is used to completely cover their loss. It's a beautiful idea. The many pay just a little to protect the few from losing everything. But how do insurers know how much to charge? It's not just a guess, it's all thanks to a powerful mathematical concept called the law of large numbers. Basically, it says that while it's impossible to predict if your specific house will have a fire this year, you can predict with incredible accuracy how many houses out of 100,000 will. And that predictability is what makes the entire business of insurance stable and possible.
Now, as great as this sounds, you can't just insure everything. For this whole pooling system to actually work, the risk you're covering has to play by a certain set of rules. So let's look at the final piece of the puzzle. What actually makes a risk insurable? So for this whole thing to work, a risk needs to meet a few key conditions. You need a large group of similar things, like all those houses. The loss has to be something you can actually define and measure in financial terms. Crucially, it has to be accidental, no insuring something you plan to do. The loss can't be so huge that it wipes out the whole group at once. And of course, the premium has to be affordable, and the whole thing has to be legal and not against public policy. These rules keep the system fair and stable. And this quote from the source material really drives home the most important rule of all. Insurance is for accidents, for the unexpected. The moment people can profit from intentionally causing a loss, the entire system just falls apart. It absolutely has to be accidental. So there you have it. From assets and perils to hazards and the power of the law of large numbers, that's the engine of insurance. Which leaves me with one last thought for you to chew on. Now that you know the rules of the game, what's the biggest uninsurable risk in your own life? Something to think about. Thanks for tuning in.